when I'm sitting with my analyst and we're discussing the business outlook, growth expectations and valuations. One company we are debating 10% or 12% profit growth CAGR, and another company we are debating 30-35% profit growth CAGR. How I look at these two aspects is how many companies grow at 30 or 35%. If I'm paying that much, I'm slightly maybe overpaying today, but it's giving me a 35% earnings growth CAGR, and we have the confidence in terms of the business, then why to argue?
I am Ramneek Kundra, and in this series we are not talking about performance, we are talking about the thinking that drives it. So Rohit, you have been managing money for a very long time. It's been more than 10 years that you have been managing DSP ALSS. Can you talk to me a little about the fundamental changes that you have made in your framework, how you invest, what are the mistakes that an investor shouldn't do while managing the money?
Thanks, Ramneek. I think over the years, yes, a lot of things have changed and you make mistakes, but how do you learn from them, right? So if I look back last 10 years, I would say the core of the framework, right? Understanding the business, management's philosophy in terms of how they want to run the business, how to look at long term, and what you're paying for it. I think that still remains. But what's happened over the years is, there are too many variables come in. I mean, if you would ask me 10 years back, what tell me the factor score of your portfolio or a momentum score of a stock you own, I would like pata nahi hai, right? But in the last few years, I think, these things have also become important. They may not be a driving factor of your decision, but you should know them. And it helps you in terms of what you are doing. So that we are trying to incorporate, not only me, and DSP also we are trying to incorporate these things. Secondly, new listings of businesses, right? I mean, if you look at the quick commerce business and few other businesses, right? In India, these businesses were not present many years back. And at least for me, the first experience was when they came to listing, learn about the business, what they are doing. So as I said, when you're learning new businesses, you come to know new trends, what you see, how to analyze, how to visualize them. You have to do DCFs for them because they have no profits, or you just have to value them on sales. 10 years back, did I own a company which I valued them on sales to market cap? I don't remember. But today maybe it could be one of the options, right? So yeah, these are the changes, or I would say these are the additions which I have made, in terms of, how to look at businesses. In things of getting things right and wrong, right? So per se, I don't like overpaying. But there have been instances, where you need to overpay. Because if the business delivery is so strong and there's a big difference in business delivery, then just to look at valuations on one side, it's not right. So you can't fight the business momentum. If business momentum is strong, it's okay to overpay, Rohit, don't mind it. So I would say in last 10 years, yeah, it's been addition to the investment frameworks. Where we thought we need to change, we need to adapt, we are trying to do that.
So when you talk about overpaying, you are essentially betting on the business momentum, but at the same time, doesn't it mean paying up rather than overpaying? Because overpaying would essentially mean that you are paying above the intrinsic value or the perceived intrinsic value of the business over time.
Fair enough. So let me give you a better example, right? If I'm analyzing two companies in the same sector, and when I'm sitting with my analyst and we're discussing the business outlook, growth expectations and valuations. One company we are debating 10% or 12% profit growth CAGR, and another company we are debating 30-35% profit growth CAGR. How I look at these two aspects is how many companies grow at 30 or 35%. If I'm paying that much, I'm slightly maybe overpaying today, but it's giving me a 35% earnings growth CAGR, and we have the confidence in terms of the business, then why to argue? But if the argument is between a 12-15% growth and a 15-18% growth, then overpaying is not fair. So that's how I see it, right?
So what brings the confidence, or what breaks the confidence in the business momentum, or how are you thinking about the probable terminal value evolving or the intrinsic value of the business growing? How do you think about that, when you debate these kind of debates, you mentioned 10% and 12% kind of debate? That sounds marginal to me. So what is
how I look at it? So if you hear me earlier also, I never say I'm buying stocks for 5 or 10 years. I don't have the vision, or I I don't have the psyche also, right, to take a 10-year view and say I'm going to buy this. What I do is when I'm analyzing a stock, I try to analyze next 18 to 24 months, right? And why I say so? Every quarter your company is going to report you numbers. Every 6 months you're going to get their balance sheets, right? So things are evolving. So in returns we talk about rolling returns, right? So for me, owning a company, holding it for many years and not holding it for 2 years, is I'm getting rolling business updates I'm getting. If they are in sync with what our expectation was, you continue to hold, you roll it forward by another 6 months, right? Because so much of data. Either you say, I'm not going to look at quarterly earnings, I'm not going to look at biannual annual reports, I'm just going to look at once in a year the numbers. It doesn't work that way. Today the data flow or the information flow or the misinformation flow, it is so much, right? So when you keep on revalidating what you're thinking or what did you think while buying a stock or selling a stock, if that thesis is continuing, right, then I'm fine with it. If there's a break, is a break a one-off break, did something happen in a particular quarter or 2 quarters, then you take a different call. You say you need to have a corrective action. But if things are going in line, you keep on rolling every 3 months, 6 months. That's how I see it.
So based on your portfolio, I also looked at your holdings. It looks it has a value tilt to it in some way, or however you define the value factor tilt, or whatever it is. Like you are buying businesses at a much lower price, or businesses that have fallen somewhat out of favor relative to the market. So I see that, but at the same time, I'm just thinking, that may eventually lead you to sell some of the businesses which may keep growing over decades, right? And or like few years after you have already sold them. How do you deal with that kind of situation? This is a situation we have seen in the US playing out, right? Like if someone was not in the Mag 7 stocks, and they have massively underperformed a lot of times. Broadly, I'm talking about. How do you deal with something like that?
I think that's a difficult situation for me, right? And it's happened with me,
Yeah.
I have bought stocks, I felt at the right price, but I have sold them earlier, and it's been the case, right? But again, you have to have some kind of a benchmark or some kind of framework you work with, right? At a price, you may feel, okay, it's slightly expensive, business is going on, price is up 10%. When do you stop? When do you get the right number? So when I speak to my investors, I don't tell them if I'm going to buy a stock today, stock yahan se girega nahi. When I'm going to sell a stock today, it cannot go up from here. But at that price, what comfort I have vis-a-vis, the business outlook and what price I am paying, and relatively to other names which I own or which are other investable names for me, right? It's all relative basis.
Yeah.
So if I feel at that price it's expensive or I need to sell, it's done my job, I will sell it. I will not be wondering, what if it goes up? I mean, if that thought comes to your mind, you will be stuck with your portfolio and you will get it wrong. I mean, that's what my experience has been.
Okay. So I've seen you have outperformed for large part of the 10-year. You have been managing DSP, ELSS, and that's a remarkable feat in itself. Like not many managers are able to outperform the indices, broad indices, for that long. But when I see your portfolio positioning, also I also see like your churn is a little bit higher compared with someone who is a long-term holder of the businesses. How do you explain that? Because you may have gotten a lot of sales probably wrong. So sort of wrong. Like broadly your results are right, but at the same time you may be kicking yourselves for one or the other business that you sold too early. So how do you deal with something like that?
I think again, Ramneek, it's very simple. So when I say I'm a holder of business, I have stocks in my portfolio. I've held them for the last more than 10 years, right? But it's the sizing, at what point of time, what active weights I had in stocks. So without naming, if I let's try to go back in last 10 years, there have been instances in the top 50 stocks of the market, right? Where at one point of time, I had an absolute weight of 7-8%. At one point, I had 2%, at one point 4%. But the stock is there in my portfolio for so long, right? So I haven't sold off. So there's the way you look at it, right? You may own the stock for 10 years, but what sizing do you own, right?
Right.
The sizing is again determined upon at that point of time, what is the outlook on that business, what value, and relatively what are the other opportunities available. So yes, again, there have been instances, but if you buy them right, it's not necessary you need to get both the calls right according to me, buy right, sell right. I think if someone tells you I do it consistently, maybe I need to learn that. But if you get one of the sides also right most of the time, I think you are there, yeah.
Okay. Okay, fair. In terms of sizing the relative opportunities, so let's say you own a lower quality business in your portfolio, which you think has reached its, you have made good money on it, and your returns have been exceptional on that one, and now you want to shift to a higher quality business which is trading at similar lines in value, but the lower quality business still has more value left. Would you make that trade-off, and what kind of position sizing do you think about? What are the factors that you are looking at that time, and vice versa, when you have higher quality stock in your portfolio and the lower quality stock become insanely attractive? How do you think about that?
So Ramneek, first of all, I don't believe in this word low quality, high quality, right? Every business is a good business. They have cycles. And I'll tell my investors, I want to have stocks in my portfolio which will help my NAV grow, and for right reasons. I don't want good looking quality stocks in my portfolio which maybe over the next many years do not give me returns. So that's my view on quality, right? Now comparing businesses, right, like you rightly said in the previous question, if I'm looking at a company with a 10-12% growth and a 30-35% growth, the lens I look at them is slightly different, right? And why is it different? If I expect that 10-12% growth to become a 15% growth, or a single digit ROE to go to a double digit or mid-teens ROE, right? Then what is back of my head? What is my investment argument? Of course, the business growth. The second part is, if this business growth pans out, then there's going to be valuation rerating also. So my returns in the stock price is going to come by business growth and also valuation rerating. Whereas another company is going to be earning CAGR led growth, and that's going to be my stock price growth. So when I'm comparing these two companies, and when I'm saying, okay, this company is going to give me 20% price appreciation and company B is going to give me 20%. In company A, I'm assuming an element of valuation re-rating, and that is how I'm getting a 20% growth. In company B, I'm not assuming any valuation re-rating or de-rating, and a 20% growth. That's when a choice comes, which one you want to own at what point and at what rate, right? If the growth, what is the driver of that growth, right? That depends the sizing and which I choose of the two.
Okay, so I've also seen you talk about moat of the business. You're looking at competitive advantages. So doesn't that differentiate a quality business from a non-quality business that you just talked about? You said all the business. So I'm looking at you from that. You look at things from different lenses for different companies, which is fine. But at the same time, when you say you don't believe in there being a quality business and just the cycle, that makes the argument completely different. Shift away from the moat, but rather becomes a valuation argument. Is that right?
So in your words, I would say, how do you define quality, right? Consistently having a mid-teens or high teens ROE,
sustainable ROE, return on invested capital,
good cash flow conversion, and a steady business, right? Now, why is that business like that? One, it's a monopoly or a duopoly, right? And it's run very well. So you don't have variations of someone competition coming and launching new products, new markets. You yourself doing everything, right? So that's the moat, and that's the moat. That is why today you're showing me those numbers. But when I'm buying that company today, why am I buying for? What's going to be the ROE, cash flows in the next few years, right? So is the moat going to continue, or there is going to be disruption? Today, AI is a buzzword. We all are worried about AI as disruption and technology as disruption. In this whole thing, we forget about capital. If someone wants to come and spend money and disrupt a business, and it may not have any technology per se, right? That's also, the moats can change overnight. So yes, you are a quality or a value for a reason. If you're buying a metal company, right, and it's in low cycle, of course the ROE will look, pathetic. But if you believe the cycle is turning, why wouldn't I buy that? So again, what is the moat? Moat is, it's a metal company. It's got capacities. Of course, where does it stand in the decile of cost of manufacturing, right? So that's the moat for it. Today the moat is not good enough for me to buy it because I don't believe in the cycle. Tomorrow if I start believing on the cycle, I get bullish in commodities. That's the biggest moat for me, right? Efficient manufacturer, got capacity, will deleverage, hopefully will make money for me.
So metals example you bring out is interesting because you also, I believe, started your career as a metal analyst.
Yes.
So no one probably is more credible than to talk about to talk about metals over here. So for the most part of ELSS fund that you have been running at DSP, you haven't invested in metals. Did you know them too close? That's why you didn't own them for a very long time?
I mean, I think if I go back 8-10 years back, we had a decent allocation to metals, right? It wasn't, and we made a lot of money in metals. Today also we own some metals, and if I compare to my benchmark, we'll be slightly higher than benchmark. But when we say metals today and metals 10 years back or 8 years back, the company name is the same, they're manufacturing the same product, but the business has changed. And I'll give you with an example. Say 7 years back, 8 years back, if I never owned a metal company, right? Thinking, okay, balance sheets are not good, cycle is not good, global commodity cycle is not good, I don't want to own these businesses, right? But when every quarter they used to report numbers, every half yearly they used to report balance sheet, I used to look at them very keenly. You'll be like, why? I used to own banks. I used to own banks who have lent them money. So if the metal companies used to go down, my fear used to be like, what if they're not able to pay interest? What if these banks, for that bank they become an NPA, right? Today, I just look at the profitability of metal companies. I'm not worried about a metal company going down and the banks which I own grabbing with NPA. See the leverage of those businesses. I mean, I remember, talking about writing in my investment thesis, 2 times, 2.5 times net debt to equity going to come down to 1.5 times, right? Price to book, which is 0.6, going to go to 0.1, and these things happen. Today, at least the companies which are part of our universe, right, when I look at their balance sheets, I don't think anyone has got debt more than 1.2 times of its equity. Interest coverage ratios, earlier we used to think 1 time, hey, it's very nice. Today, 2, 3, 4, right?
Yeah.
So again, the businesses have changed, the balance sheets have delivered. So again, how do you look at regular manufacturing company? Okay, 1 quarter of pain, 2 quarter of pain, it's fine. So metals today also, in my thought, 15 years back, 20 years back, 1 quarter of pain, 2 quarter of pain, we should not own them. Today 1 quarter of pain, theek hai, let it be.
Yeah.
They have a strong balance sheet, cash flow will come, let me continue to hold them. Of course, if I'm paying the right price for it. So that's what it's changed in metals over the last 15-20 years.
Is it also because you have become more longer term?
Not really.
Not really.
I still remember, when I joined DSP and when I used to talk to my fund managers then, as a metal analyst, my only thesis in a metal company used to be like, and that time Anup and Apurva were there, sir, ye 0.6 time price pe book pe aa gaya, let's buy it. There is no downside to it. This is the cost of production. This is the global cost of production. Prices come down. Capacity will shut down. These will do good. Today, everyone is trading at more than 1 time price to book. But here we are talking about ROEs and cash flows.
Yeah.
15 years back, you asked me about ROE about a company. I'm sorry, I don't know it. That's how it is.
Okay. And what's your framework for adding a new position? And I know every position not necessarily can be explained fully, but every add or delete from the portfolio cannot be explained every day. But what's your framework for adding a position and specifically for trimming a position down?
I think adding a position again involves various aspects, right? So if I already own a company, right? And maybe there's an event which has happened, which I feel, is just reinstating my thesis in terms of how the business is, the strength of the business. And at that price, it makes sense. So instead of looking somewhere outside, why don't you look at your business only, right? That's one of the aspects. Secondly, the good way is if you're getting a lot of flows, right? So again, flows mean you don't add always a new company what you own, at that price, because in the end, it's the NAV, it's there today, right? You have to work for the future. At that price, if you feel there's some businesses which you own, your active weights, maybe, you want to have a slightly higher active weight looking at the business potential, you look at it. If it's a new company, it's a whole grind, as we spoke in the beginning, right? Understanding the business, the moat, the management, and the whole work has to be redone. Because it's something you're looking at for the first time. So it involves a far greater time. Same way for selling. Ideally, I would like to sell, and as I told you earlier, sometimes I sell early also. If I feel the price is fair, the price today is fair, I will trim. If I will not exit, I will at least trim. Sometimes there have been cases, if I remember, I wanted to buy something and there was no cash, or I wanted to maintain the cash level which we own. So I need to switch out. I need to sell something, right? So selling, again, it could be I was it's not always not the case you sell the worst stock in a portfolio, because as a fund manager, if you own something, you think sabhi achhe hai, right? So sometimes, if you think the stock is more liquid, your impact cost in selling will be slightly lower. I don't mind even trimming those a little.
Right.
But yeah, I keep an eye on my active weights, right? If they're shifting a lot.
Yeah.
So that's how it works. And as being yourself, you're a fund manager, I guess you understand the vagaries, right?
Yeah.
Everything is good in my portfolio.
Right.
मैं क्या बेचूं?
Right.
But you have to take a call at that point of time, right?
Talk to me about a mistake that changed your perspective about fund management in a major way, where you were like, this is not the position size I should have been at, this is probably not a business I should have been in, and you got most part of the whole investment and the thesis wrong.
That's a difficult question, but I'm sure I must have done some mistakes for sure. But I think it was not, I would not relate it to one particular company or a segment, right? But the Rohit of 2016, 2017, valuation was, it's today also, but that time I would say one of the only drivers. And when I told you, right, comparing a 10% growth with a 30% growth, that time maybe I used to overlook the 30% growth companies, right? And that's a mistake I made in the calendar year 2018-19 period. So that was a learning. Yes, you don't want to overpay, but if you're overpaying for what? If there is consistency in business growth, and on the other side you're not getting growth. So like when we talk with analysts, one way is growth. Second way is your expectation, company A, company B both 10%. Company A is giving you 12-13%, company B is giving you 8-9%. So like how the jaws open. If there's so much difference in business performance, then even if this company is trading cheaper, so called, right, or value, and this company is quality and growth, I mean, at point you need to pay some higher value for it because of the business divergence performance.
Okay, so how high would you like to go in terms of valuation? I'm not talking about like the PE ratio or anything like that, because that's like very subjective, what you want to consider a good multiple for a certain company. But how high are you willing to go for a difference of, let's say, a 9% and a 12% growth when the business is materially different?
9-12% growth is not different, right? But one overshooting the growth consistently and one undershooting the growth consistently, then that's where the difference is, right?
So
Sustainability, right?
Okay.
Because if you think, and that's how you avoid value traps.
Yeah.
You'll see stocks at the same valuation but at the same price for many years,
Yeah.
right? Unless there has to be a trigger for it, right? For the value to emerge. If there is no trigger for it, I mean, you may buy it today at the same valuation, and after 5 years you may realize, "Arey, ye kya ho gaya?" Nothing has happened to the stock.
Right. So, give me a little more context in terms of two businesses. Let's say one business has no leverage, right? Delivers consistently, has been in business for, let's say, 50 years or so, and consistently delivers high ROEs and high ROICs, let's say 40% and stuff like that, and you know that the sustainability of the business is quite high, and this business is trading, let's say, 30 times free cash flow, right? And there is another business which is trading at 21 times free cash flow, but has a little higher leverage and delivers higher growth, let's say 50% higher growth. Which business are you most likely to? Are you going to value?
I know what you're coming to.
Are you going to give higher weightage to the debt part of it, the balance sheet part of it, or are you going to weigh the growth part heavily?
I think numbers are the outcome of business and business outlook, right? So if I have, say, confidence on both the businesses, right, in terms of their future growth potentials, the drivers, and the continuance of moats, right, then the question comes is again, why are you buying them? If you have a similar type of business already in your portfolio with similar metrics and growth, then you may say, okay, let me buy one with a maybe slightly higher debt, or vice versa. So again, the business confidence needs to come in, Ramneek, right? And what you're paying for it, I would say in Hindi, you call a word called Shraddha, right? If someone is buying, someone is selling. If someone is selling, someone is buying, right? So always to get that right, or to assume you'll get it right, I don't think that way, right? So again, a combination of, if the debt today seems high, can in the next 2 years the debt come down? I mean, talk about enterprise value. What is enterprise value? It's market cap plus debt. So even if my enterprise value, I expect it to remain constant for the next 1 year, 1.5 year, but because my debt is coming down, it's getting calculated into market cap. So I would say I would be indifferent to the numbers if I have confidence on the business, and if I own similar businesses, I would like to diversify. Say, let me buy this. So I would not go by just numbers. 40% ROIC. I mean, today there are so many companies in top 100, right, with more than 30% ROIC.
Right.
And what is the expectation of earnings growth, right, going forward? What is the incremental ROE, ROIC you're going to make?
Yeah.
So again, as I said, past is a starting point which gives you the scalability, cyclicality, sustainability of the business. But can it continue in the future also? I mean, you have to make those assumptions and reset your mind to it.
Yeah, so I always believe one of the things that if you don't have an idea where people would be like, this is crazy, that this doesn't make any sense, and if you don't have one or two of those ideas, you're not really a contrarian investor with like variant perception of sorts. What's that one or two ideas? What's those one or two ideas where people are like, Rohit to ऐसे ही करता है?
So मेरे दिमाग में वो नहीं है, भले सामने वाले के दिमाग में हो, because for me, whatever I am buying, right, just because people think I'm contrarian, in my mind I'm not. I'm trying to find business at right value. People think that's contrarian, that's up to them. But how I see it is, what is the business? Is there going to be some changes in the business model? So we have bought stocks where in the last 6 years, 7 years, the stocks haven't done anything. Valuations are there where they were even 6 years back, 5 years back. So I would have bought the same stock even 5 years back, 4 years back. In the valuation argument, I would have written the same. It is cheap, it is value, right? But it remained same for the last 6, 7, 8 years, right?
When you talk about this, is it a valuation multiple or you're talking about the price itself, the consolidation of the price?
The valuation multiple is also important, right? Because what happens is, why is the price consolidating? Price could be consolidating because of the business not growing, right? Or maybe the growth coming off. So market cap of the business is not moving anywhere, right? And so is the valuation. When does the valuation move? Where you see the business performance or the business metrics or something changing in that particular sector, right? And I'll give you this with an example, if I may. I think if you look at power financiers, a few government-owned private financiers, last 4-5 years has been a good period for them, right? But if you go back, if you subtract 5 years from the last 5 years, it was a straight line in terms of valuation or stock price. So as a Rohit, I would have bought them 8 years back also, 9 years back also, right? Because I want to be contrary. But we never owned them in a portfolio. We bought them about 4 years back in 2022. So what changed in the thought process, right? The view on the power sector. Whom are you funding, right? What's happening in the sector becomes very important. Did we see some changes happening in the sector? Did we see the entire thermal word, which was a bad word till then, becoming a good word? Everyone talking about thermal, right? So you had one leg of business which was not doing anything or expected not to do anything, that coming back. Secondly, the financiers, the thermal had to come back. Who would finance? All the bigger banks were saying, we don't want to finance because we have hurt our balance sheets. We'll wait and watch. Every quarter, these companies were writing off their books, right? Because some power projects for 50% complete, 70% complete, 30% complete, right? And no completion timelines were there. Now those projects, you had buyers for them, you had bidders for them, which was already written off. So you had, now that value which the businesses had, those value could be realized. One, your top line growth because of new projects coming in. Two, if you're an asset owner, you have written down the project, and if there is a buyer and you're paying $1 to $1, what kind of benefits you have. So I would say that's what you look at it. When I'm saying value or contrary, that's what you look at it. It's not like it's cheap, so it's contrary. There has to be something to change in the business or in that particular sector for that to happen.
Okay. So what are you seeing? You own some oil marketing companies, and I don't see those in many portfolios. This is sort of me. To me is a contrarian investment. So what do you see in those, and why choose only 2 of those, and those 2 specifically?
Yeah. So I would say again, so OMCs, it's been the love and hate relationship with them, and whether it's a OMC or any other businesses, right? But again, every business has got its value. and how the promoter or the management of the businesses or the owner, they think about it. I think that's more important. So OMCs today we are talking about it because they are government owned, right? On the other hand, you have defense businesses also, a lot of them are government owned. You have a lot of financial businesses also which are government owned, right? So what you need to figure out, what has changed in the whole value chain of OMCs, right? Till 3 years back, even we used to worry about it, in terms of what if, there's a cut in petrol, diesel prices, the profitability of these companies will come down. But again, it's my very personal view and I have been talking about it openly. When I see last, and I may go wrong, tomorrow something may happen, but that's how I see it today. In the last 2.5 years, you have seen, the central government election, you have seen few state elections, you have seen crude go to above 100, come down to 60, again it's 70, right? The prices have been kept unchanged. Yes, we had some cut in February, March this year, but I would say a very piddly sum, in terms of what could have happened. When we hear the management talk or the ministry talk, you get some sense, how are they thinking about the business? Are they thinking like owners or are they thinking like someone else? So that's the comfort, right? So that's where the OMCs are today. And again, what price am I paying for today? You compare them with last 10-year averages, you will say, Rohit, ye value nahi hai. So you're going contrary to your style. But yeah, if the business metrics is changing, right, and you're getting some more confidence on how it will run. So that's what we are playing for, right? So at crude 70, hopefully it remains here and there. I think it's a very sweet spot for them, right? So that's my view on OMC. It's a pure bottom-up view. Yes, over the last 5 years, maybe, and today, I have more confidence in terms of how they are run or how someone will behave with them.
So what changes the view over here, like crude shooting up or?
Of course, crude shooting up and reasons for crude shooting up, right?
Yeah.
So if you remember, this about 1 month back, or the first or the second day of Israel conflict, right? The crude was up like almost $9 in 2 days, right? So if such kind of events, then as a fund manager, as an analyst, one needs to take a call. Is this a one-off or is this sustainable? If I have reasons to believe today कि $100 crude or a $90 crude is a sustainable level of crude for next few 1, 2, 3 years, right? Then I would not own them, right? Because, and if you have these variances, maybe it has an opportunity for me to add to my weight. So that's how I see it, unless the profit drivers, Moats. Crude is one because that depends upon how much petrol diesel is selling per liter. Will you be allowed to increase it, decrease it so often? GRMs. So what's the moat? If today if I have to believe crude is going to be at $95-100 on a sustainable basis for fundamental reasons, maybe I may not own them.
Okay, so there's this one possession of yours, which is the tower company, right?
Mm-hmm.
And you could have you own Indus Towers, if I believe from the last fact sheet.
You have been owning it for some time now. Yeah.
For maybe 2 years or so.
A year and a half, or almost 2 years, you can say.
Almost 2 years.
Yeah.
But I saw one interesting thing when everyone was basically, all the mutual funds were buying Bharti Airtel itself. You also bought it, but at the same time your position in Indus Towers was much larger than Bharti, probably like 2-3x larger.
Mm-hmm.
So how does that happen, and why would that happen? Why would you do that?
Okay. So and what is Indus Tower? Indus Tower is a tower company which telcos use for the signals, right? That's the business of Indus Tower. Till a year and a half back, before that, what was the business outlook for Indus Tower, right? We as industry were not sure there are going to be how many telecom players in the country, right? And the fear was whether it's going to be a 2-player market, 3-player market, or a 4-player market, right? One to the day. So the fear was if industry consolidates, will the tower addition come off, right? So the business where Indus Tower is into, what will they do, right? If there are no companies going to invest, and if there is consolidation, what if the customers squeeze them, right, in terms of their profit margins? Once we got a sense that it's going to be a 3-player market, and when we're hearing in terms of media reports, how they are talking about their expansion, how they want to look at their debt, and what kind of payments they are going to do. So we said everyone is bullish on Bharti, even we were bullish on Bharti, why not, right? But then who are the other ones in the value chain who benefit of something happening in that end user industry?
You mean second derivative?
Second derivative, right? And then we met the management, what they had to talk about their businesses. So the starting point was, Bharti and Voda doing good, expectation of them doing good, Jio doing well. Then if they do well and if they have to expand their businesses, who benefits out of them? And that was starting point. And plus, at what price we were paying them, we entered, so that it had the comfort of that also. So business comfort first, and it happened, while meeting a company. If someone is talking so much good about the industry, why not look at this? Like same example I gave you for power, right? If someone is talking something so good about their sector and we believe in that, who else can benefit in the value chain?
So, when you met the management of Indus Towers, like, are there any green flags that you look at in a management? Are there red flags? What are some green flags and red flags? So there are like two questions. I'll divide them. What are the green flags that are underrated in a management? What are the red flags that are underrated in a management where they are meeting? I'm guessing they are meeting a lot of fund managers, but you were the one who basically, you were one of those who actually took a larger position. So
I would say, a green flag and red flag is, fund, how much as a fund manager or as an analyst, we understand the business, right? Because that is more important. Management may tell you whatever, but what is your understanding of the business? So what you're trying to do is, when you understand the business, when you're meeting a management, what you just try to figure out, the dynamics of it. How are they thinking? How are they thinking about capital? These are the questions you want to get answers to, because today even they would not know how much capacity addition is going to happen, right? They may feel, yeah, because how I'm feeling, right? Yes, now this industry is going to survive, but will they have the timelines? They will not have the timelines. So it's that call you want to take, unless the management is really talking something different than what you're thinking. Right? That's what you look at it. Because at that point of time, I don't think even the management will be able to tell you कि सब अच्छा है or सब खराब है, right? Red flags, again, it doesn't come out of the meeting. It comes out with the past, your interactions with the management, or how you have seen them behave, right? In terms of what they talk about their businesses, end delivery, their capital allocation. So I would say, coming out of the meeting, it's like green flag is all on you, right? What first you're thinking, and then what the management had to say. Red flag is, if you know this management is going to lie to me, that's been my past history with them. Why to also meet them, right? So I would say green and red is like, where are you thinking? Is the management also thinking in those lines? Do they have the data which you can infer? Yes, Rohit, you're thinking in the right direction, or maybe you need to tone down or be more aggressive. That's what you try to pick up.
Got it. And you talked about relative valuation relative to the market or your benchmark or different opportunity set that's available to you, opportunity set of companies that are available to you. How do you judge whether the benchmark has gotten expensive, not just based on like P ratios or just beyond P ratios and price to book and all of those ratios? How do you judge like the benchmark is expensive and my risk reward is not there?
So Ramneek, today, even we as fund managers, we asked, market is cheap, expensive. So how do I answer the question, right? I need to look at the benchmark and say, this is the benchmark, 5-year, 10-year history, this is where we are, right?
Yeah.
So that number I know. If you would ask me, Rohit, what is your stock portfolio PE or PB today, I would not know it. Because I'm not buying or selling a portfolio, I'm buying, selling stocks. So those parameters I need to know at stock level. Right?
That's the outcome of it.
That's the outcome of it, right? Same in benchmark, there may be few stocks, who are driving these numbers haywire. And again, I don't remember which year it was, but I think it was 3 or 4 years back in Nifty 50. We had Gas Authority of India getting out of, and why I'm talking about this is because we discussed internally, right? GAIL was, I think, a sub 1% weight in Nifty 50, and it was replaced by Kotak Bank at that point, and Kotak Bank came in with a 2.5 odd % weight, and maybe 10-15 basis points here and there. GAIL, a low single digit PE company, less than 1 time price to book with a less than 1% weight, getting replaced with a 2.5% weight company with 4 times, 3.5 times price to book, 15 times PE. Your index is going to look expensive the very next day, right? So yes, as in benchmark, you need to put those. But if you focus more on stocks, right, I think that's more important, and that's what has worked for me. Looking at benchmark PE and saying it's expensive or cheap, is it giving me a stock idea? Probably not, right? It's the individual stocks which I focus more on.
So how do you deal with running bull markets and when stocks it looks to me that you are like very value conscious. So and you do believe in margin of safety. So how do you deal with like runaway bull markets and when stocks really get expensive? How do you deal with incremental buying and selling? That becomes very tough.
I need to stay calm. So it's been instances in the last 2 years, and it's public knowledge, right? I've sold stocks. The stocks have gone up 20-30% in the next 4 months period, right? So you feel, Rohit, tune kya kiya, right? Did you do something wrong? But again, at that point, the reason for doing it, it could be maybe valuations only, maybe some business. It's fine, things will go up, go down. But at what price or what value you think the business is right, you need to take the call. You can't leave everything to the market. Otherwise, as I said, for the last 2 years, I've been learning a lot on momentum, right? And I should stop looking at fundamental analysis, just go by momentum, Ye momentum itna aa gaya, gir raha hai, chalo let's start selling.
Yeah.
But then that's not how I am, right? So it has a fundamental bias with these kind of inputs. It's fine, you feel bad, but you feel good also, stocks which you have sold that they come down, and you feel like. So I think it's you said it's a give and take relationship. I mean, it's fine, you get it wrong. And I'll get it wrong, specifically a fund manager like me, who believes in value. And if it's a bull market and the valuations are just driving away returns, and they're a major part of returns. I mean, I would go wrong on those periods, I would be in, out, or maybe selling it earlier, but it's fine. Yeah. I mean, I cannot, the market behavior is not in my hand. The stock business, the stock price, what value I'm paying, at least I can take a judgmental call and, behave accordingly.
Got it. Makes so much sense. It also seems that you sometimes go up to more than 50 stocks in your portfolio.
Always.
So I didn't want to.
Always.
So you have many stocks in your portfolio. Isn't that too much diversification for you?
Sometimes even I think, because I get asked this question from everyone. Rohit, you own 60 plus stocks.
Yeah.
Sometimes I feel, should I do something about it? But when I think like this, when I sit in my portfolio, what should I do, right? I think, Ramneek, it's a combination of, I think, last 3-4 years, what's happened in the market also, right? The kind of moves which you have seen has been very quick, and I believe is, if something you are buying, and if you have 1 or 2 options in that particular business, then we don't need to own the best in the class. If you have some kind of a basket approach and say, okay, I'll own them. What's happened is specifically in the last 1-2 years, I've started buying a stock. And the stock just moves up 15-20% in a couple of days time, and you didn't get a weight. So you feel like, if you get a good price, maybe you want to add it, you want to see that in your portfolio, so it's there, visible, and it's a fact, right? Out of sight, out of mind. So when you thought of buying it, you had a reason of buying it, right? You stopped buying it because of maybe the price went up or something, So you want to keep it. So we try to do that. At some points, if you feel after 3-4 months, okay, now this is a dead weight. The stock does well, my portfolio returns are not going to be driven by it, let me get out of it. So I think that's also one of the reasons. And secondly, I said the basket approach. If I feel one segment is going to do well, and if I get 2-3 companies, it helps me on my liquidity cost and my impact cost also while buying and selling. And it's not been new, Ramneek. If I remember right, I think I've always been 55-60 stocks since I started managing the funds. So I think it's worked well, so I don't even want to tinker it just because the number looks high or low. But yeah, I mean, it's always in the head, why you have a sub 50 basis point position, question come, is it less conviction, or do you don't understand more of it? So if I don't understand more of it, why will I own it? Just the price moves in between, that's what I think helps. Yeah.
Right. Yeah. I've experienced that.
Yeah.
So you said out of sight, out of mind, right? So in terms of tracking certain businesses, what's the team that you use, and how many stocks does your team track, and how will you survive if your team is taken away from you for, let's say, like a month?
And that's an interesting question. So let me try and answer the second part first, right? I think personally I have a very strong belief in my research team. And why I think so is, myself also, as my career progression, when I started 25 years back in this industry, I started as an analyst, right? And that time, being in sell side, used to cover stocks, do in-depth research, and pitch your ideas to fund managers. when I came to the buy side in DSP, though the role changed from sell side to buy side, but as analyst, the core thesis was you understand the business, do it. And when I used to talk to fund managers, right, what an analyst has an understanding of a particular business. I would not say all the fund managers will have the same kind of understanding, right? So for me, analyst work is very important, the kind of depth they go into. And if you have a good team, right, and once you build that confidence over a period of time, कि चलो रमनीक ने कुछ बोला या रोहित ने कुछ बोला, उसने सोच समझ के काम करके बोला है. So your starting point becomes easier, right? So if you would say, if I would have no analyst team for next 1 month, would it make a difference to me? I would say I'm sure no, I would not buy into new ideas. Someone who come to me, I would not buy. I would take some time to buy it, right? But in terms of running the portfolio, because you own the stocks, you own a lot of them already, 60 plus stocks. So running a portfolio will not be a problem 1-2 months. But yeah, a new name coming in, totally a new business or which is not there, probably that would not happen in the next 1 month. I would say. I mean that's just my thought, because I truly believe having a good analyst team, it's really helpful. You may say, and I know fund managers who have got different views, but I believe in that. In terms of coverage at DSP, we cover about close to 300 plus stocks. And when we say we cover those stocks, is we have models of those companies, all the 300 companies which are updated every quarter, like a sell side kind of a research, quarterly interactions with the management. So all that is a part of the research process. So again, today, if I want to buy a new company, right, and again, since we're talking about process, I would like to bring in a forensic word, right, because that's one role we at DSP, really pride ourselves with. It's been about 4.5 years, where we hired an analyst, and his role is forensic analyst. The job of the role is not to tell me this business is good or bad, you should be buying them or selling them. His job is to tell me the way the accounting practices of this company is, how aggressive, good or bad it is, right? If they have to normalize their accounting practices as a norm, right, what could be the materiality in the profit or the outlook? Sometimes, we as fund managers, seeing those companies for last so many years, meeting the management for last so many years, we get biased. We talk about the business, growth, outlook, and these things we say, chalta aa raha hai, right? But sometimes, when we realize, this is the law of land. I mean, they're reporting this way, it's the law of land, as they're reporting it. But if to be true to the nature, if they were supposed to do it, your reported numbers could swing by 15, 20%, 30% here and there. So then we keep in mind, if that swing can happen, Rohit, at this price, you think this is value? Is it value or no? We categorize the companies into red, amber, and green. Red is, there's serious issues we think, and as a fund manager, whether it's me, Vineet, or anyone, we cannot buy those companies. So I think that's one, we pride in a research process. But yeah, and to summing up, I think research, is very important. Research analyst's role sometimes gets, undermined, because everyone in industry talks about fund managers, NAV growth, quartile 1, quartile 2. Back end, even the guys, ladies who are working on it, I think they have a very important role to play.
And what was the most frustrating part of being, just curious, of being an analyst versus being the other side of?
So I'll tell you, and why did I come to decide? So in the first 5 years of that time, markets were different, right? You had not so much of media, news, phones in the hand, right? So as a sell side, what was your expectation at that point of time as an analyst, right? You do big research reports, you come out with industry norm, you come out with company 50, 60, 70 pages reports, sector reports, right? And you go and meet a fund manager and he says, क्या लग रहा है? I feel like, sir, 60 पेज की रिपोर्ट लिखी है, इतना लग रहा है, ये पढ़ो तो सही, क्या लग रहा है? So the 60-page conversation was a 5-minute conversation, and the book you're just carrying so that the person meets you. I think that was the most frustrating part. That's when I decided, if I have to do this work but it's not getting appreciated, might as well do it for someone else. Maybe I will do it for yourself and appreciate it. That was the most frustrating part. And the easy part, I would say, and that I realized when I came to buy side and started managing money is, as an analyst, it is easy to say, Ramneek, buy a stock. It's a 20% upside. Ramneek, sell a stock. But today when you're acting on it, right, as a fund manager or as a buy side analyst also when you're recommending a stock, and if FM or PM agrees to it, right, it's going to be executed. So as we say, the skin in the game or the what subsequently what's happening, there are many steps involved.
Yeah.
So there's a big difference also being a sell side analyst and a buy side analyst. you may say मैंने किया था 4 stock, एक चला एक नहीं चला, but in buy side you have to be careful because there's money, people whom have trusted you with the money, and you are acting with that, right? So I think that's the frustrating part of that. Come out with big notes, and the meeting is done in 30 minutes. You just say what is the business, what is the valuation, what is the competition doing, and you're done with it.
Can you talk to me about the most uncomfortable, high-sized position that you have held through, and talk to me about the name or anything that you have done in the past?
Uncomfortable position.
Uncomfortable position where you had super, you had conviction in the valuation of the business and the business, but over time it became just very difficult to hold through.
I would not name them, but I own 2 companies. I still own my portfolio, right?
Okay.
And every quarter when the numbers come, I think, why do I own them? The good part is, when I initiated positions and I never added to the absolute number, right? So it's not a very significant position. But every quarter I think, isko bech dete hain, But that's, I would say, for frustrating me, these 2 names. If I would not own these 2 names today, I would probably have not an answer for you. But sometimes you feel, you have taken so much of pain, and relatively it's fine, it's got the same nuances, good or bad, as other names you own. So let's keep it there, In between, you get chances to buy them. You feel, gir gaya hai, and buy them. That call I have taken in my mind is I'll wait for 1-2 quarters. Let the consistency prevail, and then I will jump into more to it. So yeah, there are 2 names which I can think of, I would not like to name them. But yeah, there are 2 names in my portfolio, which give me that feeling. What you could have done differently, yeah.
So why continue with them in the first place?
So there somewhere I'm in that value trap in those 2 names.
Okay.
Right. As I said, I need to avoid value traps. So they are learnings for me, right? So that is why the change in the business, the outlook, right? You need to, be very sure about it. So I'm owning them because it's like, it's a relevant position also. But for me, even the 2 name, it's relevant for me, right? Because at some point of time I thought something. And the downside when I see today, it's not there. It's not giving me the upside, so it's an opportunity loss. It's not much of a capital loss, right? So that's how I'm seeing it today.
If I give you a fund, or if DSP gives you a fund today, a new fund, 10 rupee NAV, and it starts, it has a flexible mandate, would you do anything differently compared with what you are doing right now? Would you still own 60 names?
I would say, why new fund? Give me money in my same fund. Why not have a new old fund offer, right? What we did 2 years back. Why have a new fund offer?
That's true. But at the same time, would you still own 60 names to begin with?
Probably not.
Would you own those 2 names?
For sure, no.
Yeah.
Let's be very candid about it. Whether I would own 60 or no, it depends on how much money you're giving me.
Right.
If you're giving me a few $1 billion, I would still own them, right? But if you're giving me at least a few million, then I would think differently, right?
Got it. And is there any advice you have for people who are starting young as fund managers or managing their first fund and starting at new funds? What's the advice you would like to give?
Please read a lot about cycles. And tell you why I'm saying this, right? What worry I have today, if you have a new breed of fund managers or analysts in your team or somewhere you're meeting, right? They have just seen the stock price go up like this. They haven't seen it go down or be flat also for longer periods of time, right? They have just seen one-way market. So how would they behave? And that's where the behavioral aspect comes in, right? कि अगर 6 महीने में कुछ नहीं हुआ. So I would be very scared if one of my analysts comes to me and tells me, sir, we had discussed this stock 1 year back and we had bought it for this reason, but the stock 1 साल में कुछ चला नहीं है, let's look at new ideas. That will be my biggest worry. Why? Because he or she is not coming to me and saying, so there has been any change in business fundamentals, business things what we had discussed 1 year, 9 months back. Just because the stock price is flat, it's giving him the behavior, making him come to me and saying, let's look at differently, Rohit, stock price ने कुछ किया नहीं है, because that's the behavior, right? So my advice to new fund managers would be, every time we like learning from the near. I mean, sometimes near can be just one-off things. So please read cycles, read a lot. There will be phases of underperformances, right? Keep your head down, right, all the time. Try to learn about it and don't just try to do things, or you say, like Kalpin, our CEO, he always asks the question, is it activity or it is work? So don't do activity, just because something is going wrong, you feel like कुछ नया करें. नया करने की ज़रूरत नहीं है. Just do what you think is right, and you'll come out of it. I mean that's because I'm sure if there's a new fund manager, he's capable enough, he's been well vetted off, he's done his research, so he's there, right? So these are the behavioral aspects maybe one needs to be aware of.
Got it. We all know there is no perfect philosophy, no perfect manager. What matters is clarity, self-awareness, and the willingness to evolve when the world changes. This conversation isn't about judging who is right or wrong. It's about giving you a clearer lens to judge the philosophies behind your money. Thank you for watching Ramneek Kundra Show. Until next time, keep asking questions because good questions lead to good decisions and good outcomes.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.